Good morning and welcome to today's market briefing. Let's start with Wall Street's close on Friday. The three major indexes ended virtually flat. The Nasdaq finished at 25,520, the S&P 500 at 7,457, and the Dow at 52,146, all with near 0% changes. But beneath the surface, tech heavyweights were under noticeable pressure. The QQQ ETF dropped 1.08%, Nvidia fell 1.53%, and Tesla lost more than 2%. On the defensive side, crypto-linked assets like IBIT and MSTR actually gained, signaling capital rotating into safer havens. Overall, the market saw shrinking volume and a neutral to slightly weak directional signal. Now let's look at the global macro picture. The 10-year U.S. Treasury yield held steady at 4.54% for the week, with no marginal change in liquidity pricing. That means no clear signal of tightening or easing. The VIX, often called the Fear Index, stood at 18.77, which is in the upper end of the normal 15 to 25 range. Market caution remains, but it hasn't escalated into panic. The U.S. dollar index hovered around 100.75, still in a weak range and posing limited pressure on emerging market assets. Oil prices traded in a mild range, with WTI at $81.78 and Brent at $88.10. Gold remained elevated at $4,018, continuing to reflect risk-off demand. Putting it all together, we are clearly in a risk-off mode globally. The key evidence: the VIX staying above 17, gold at high levels, and last week's sharp drop in Chinese tech stocks. The condition for a shift to risk-on would be the VIX falling below 15 and U.S. equity futures rising more than 1% for 2 consecutive days. On the currency front, the onshore and offshore renminbi both traded around 6.77, with very narrow weekly movements. Depreciation pressure is manageable. If A-shares continue to fall, the offshore yuan could weaken passively, but a break above the 7.0 level is unlikely in the near term. A stable yuan provides some buffer against northbound capital outflows, but panic sentiment inside China's A-share market remains dominant, so foreign capital is likely to keep flowing out. Over the weekend, there were no new confirmed developments on tariffs, trade, or technology restrictions. But existing risks like semiconductor equipment controls and AI chip bans continue to weigh on the tech sector. For today's A-share open, a lower start is highly probable. The Chi-Next board crashed more than 7% on Friday, and with no positive catalysts over the weekend, downward momentum is hard to avoid. The only scenario for a flat or slightly higher open would be an unexpected policy move like a reserve requirement ratio cut or an interest rate cut within the first 30 minutes of trading. Let's move to the A-share outlook for today. The index direction is likely weak with choppy trading. The Shanghai Composite fell 3% on Friday to close at 3,764, just a hair above the previous low of 3,750. Today, we expect it to test support in the 3,700 to 3,750 range. There could be a technical bounce during the session, but a reversal is unlikely. If the index opens directly above 3,820, that would signal an unexpectedly strong recovery in sentiment and we would shift to a wait-and-see approach. For sector focus, we continue to highlight utilities and power stocks. This has been the defensive capital gathering point for 3 consecutive weeks. The summer peak electricity demand logic remains intact. With macro risk-off sentiment still present, power stocks, especially hydropower and nuclear power, have clear defensive qualities. As for tech stocks, the risk of a dead cat bounce is high, so we advise against participating in any rebound attempts. On the risk side, high-valuation tech names remain the biggest danger zone, including semiconductors, AI, and new energy. The Chi-Next board fell more than 7% in a single week, and the trend has not stabilized. External tech restrictions continue to apply pressure, and U.S. tech heavyweights like Nvidia and Tesla also fell on Friday. With both internal and external forces aligned, today could see another round of valuation compression. Avoid chasing rebounds. As for northbound capital, net outflows remain the more likely scenario. Even though the renminbi is stable, panic inside the A-share market hasn't dissipated, and foreign investors tend to reduce exposure in such conditions. The key signal to watch: if the net sell volume through the Shanghai and Shenzhen stock connects exceeds 20 billion yuan in the first 15 minutes, a full-day net outflow is highly likely. If we see net buying instead, that could support a bounce. On individual stocks, there are no high confidence buy signals today. In a weak market, we only highlight names to avoid. For positions, a Japanese INP substrate stock remains relatively defensive. Its logic hasn't been broken, so we recommend holding but not adding. If it breaks below its 200-day moving average, cut the position by half. For AXT, a U.S. company with Beijing-related geopolitical risk, the situation has escalated to very high. We recommend exiting all existing positions and not attempting to catch the bottom. Let me wrap up with today's core judgment. A shares have been oversold after consecutive declines, but external risks have not dissipated. Today will likely be a choppy session with a defensive tilt. Focus on utilities and power stocks. Our probability estimate: 15% chance of an up day, 45% chance of a sideways day, and 40% chance of a down day. Stay cautious and stay defensive.